Good morning, everybody. It is August 9th, 2019, and we are going to talk about a couple of things that play together that folks probably don't think play together. And we're going to talk about trade war and some of the unintended consequences. We're going to talk about oil. We're going to talk about gold. And we're going to talk a little bit about cryptocurrency at the end, in particular Bitcoin, and a trade that I did it at just for myself, really to get to know the market. So I've been crash coursing cryptocurrencies for just about exactly a year now, and I think I have some answers. And I made a lot of money on a trade. So we can take a look at that, and we'll go from there. But let's start with the fact that the U.S. economy is slowing down, as it is in most of the rest of the world. So all the numbers coming out pretty much are telling us that the global economy is slowing down. And it's not crashing, and it's not looking like a financial crisis, but it is looking a lot like slow growth forever, which I've talked about over and over again. And that is the combination of demographics, global debt, changing geopolitics, changing trade structures, supply chains moving due to technology, other disinflationary impacts of technology. And that's not going to change anytime soon, hence the slow growth forever global economy. So the structural changes in the economy continue. We are going to continue to see bad policy implications. We're trying to get the Fed to loosen up, and they have. President Trump especially is trying to get the Fed to loosen up. But when I say we, I mean Wall Street. Wall Street wants the Fed to cut interest rates and do quantitative easing because that's what fills their pocket. And it's not necessarily what helps you as a working person in America. If you're purely an investor, it can be remarkably helpful. But right now, we are mostly seeing monetary measures being taken around the world, and the United States is doing very little at this point. We just ended quantitative tightening, which I've been calling for since it began. Never made sense to me why a generational problem they would try to pay for so quickly. They should have put the Fed balance sheet on a 30 or 50-year mortgage, essentially, rather than trying to ramp it down. So they've had minor impact on the Fed balance sheet, lowering it a little over $1 trillion, I believe, 1.3 trillion. I have to look that up. But that 1.3 trillion was money that came out of the economy. It's largely contributing to why the economy has slowed down. The trade war is a big deal, but the Fed was tightening first. So we have to take a look at Fed policy in addition to the trade war and see where that's likely to take us. And I think that it's going to lead us to a pretty violent place here in just the next couple of months. So we will talk about that in just a second. But again, we do know that the producer price indexes, not only here but in China, have fallen. If you're not a subscriber to Bloomberg, it's probably the easiest thing to read for you. So if you're going to subscribe to either Financial Times or Bloomberg or Wall Street Journal, I'd say go with Bloomberg. Nice charting. It's laid out, the easiest to read of the three, although I do think Financial Times has a little bit better analysis. Bloomberg is super easy, and they have a couple different options there. But their terms of trade newsletter is very good. This is one of the few dailies that I get. Almost all of my newsletters are weekly just because, I literally get over 100 emails a day otherwise, and I'll never keep up. Producer price index dropped in China. That was news the other day. You really can't get away from it. Germany is having major manufacturing problems. So there is a slowdown everywhere. And ultimately, it's not just having more money in the system that's going to help. There has to be a very large, not just national in the United States, but there has to be an international effort to shore up the infrastructure of the entire planet. Not only because a lot of it is crumbling, particularly in the West, because that's the older infrastructure. Much of the infrastructure in Asia is actually newer, but also because of climate change. And again, I just get tired of having that argument. I think most people here understand where I'm coming from by now. Climate change is happening. Who cares who caused it, even though it's probably man? And how are we going to adapt to the impacts? How are we going to adapt to the droughts? How are we going to adapt to a freshwater crisis? There are massive, massive projects that could be built that would employ a generation or two generations of people, and that would allow us to secure ourselves. And when I say secure ourselves, I mean having food and water and a little bit more safety from the elements. The Pentagon has identified that mass migration is the biggest threat to the world now, because so many people are going to have to move away from coastal areas. Simply going to have to move off of the beach that they're on or the areas that they're in, because the weather will be too extreme and the sea levels are rising. Talk to the mayor of Miami or New York. They're both dealing with how to secure those cities, much in the way that some of the Northern European nations have done, Finland in particular. Hoboken brought in somebody, I think from Finland. It could have been somewhere else, could have been Amsterdam. I don't remember, to protect Hoboken. I mean, they're ahead of the city of New York on this. So there's a lot that can be done from a fiscal standpoint to secure not only us, but to really drive the economy. And when you hear talk about things like the Green New Deal, all the concepts behind it are probably right, with the exception of how they finance it. You don't need to borrow tons and tons of money. You don't even have to print tons and tons of money, like the modern monetary theorists talk about. Probably there's a time for a helicopter money drop that has to do with the retirement systems going broke. But to rebuild the planet, all you have to do is change regulations. All you have to do is ban coal. All you have to do is improve mileage standards. There's not a lot of things that have to be done from a dump money into it standpoint. All we really have to do is change the rules a little bit, and then the market takes over. Why does the market take over? Because greedy dudes like me want to make money, right? So speaking of greed, I did introduce the greedometer recently, and I think the greedometer is going to be a regular feature for us. I hope that nobody else has it copyrighted. But, we talked about the greedometer with our hedges last week, actually this week. I mean, we had the VIX call options, and we had the SPY puts. I almost tripled my money on both of those trades. I got emails and messages that a whole bunch of you doubled and almost tripled your money. I think somebody said they made a 4-bagger, so they must have got in a little bit better and got out a little bit better than most of us. But hopefully, at a minimum, you took advantage of the asset allocation shifts that we've been doing for the last several months, and you were heavy in cash going into the correction. And at this point, we don't know which way this market's going to go. It's an ambiguous setup from a technical standpoint. It could zigzag down to the December lows could go, although I don't think it's going to quite get that far, but it could. December lows are very, very possible, wipe out all the gains for the year. And then if all the gains for the year are wiped out, now it becomes ambiguous, even more ambiguous, because you have the end of quantitative tightening. You have a Fed that may become more assertive, and that could be good for assets and ahead of any real slowdowns that I anticipate for next year. So the volatility between now and an actual deeper economic slowdown, which would show up in GDP numbers, I think middle first quarter next year to sometime in the middle of the year during those 4, 5, 6 months, is going to be interesting. So if you want to do some of these VIX trades and some of these hedging trades with me, you are more than welcome. But if you're not real into the technical analysis, if you can't have your finger on the trigger button on the clicker, if you don't really understand how to trade, then don't do it. Asset allocation is anywhere between 50 and 90% of your risk management and your potential upside. It's more important than trades in most cases for most people, although great trades are great. But for most people, between 50 and 90% of performance is strictly asset allocation. And as we've talked about a few times recently, Zacks, which is one of the places that I still subscribe to, I've been getting rid of a lot of my subscriptions and just keeping, best of breed, the ones that I use the most. Because I was up to 40 subscriptions to different research services. And Zacks demonstrates pretty convincingly, and ETF database makes it pretty clear, that if you stick with the best sectors and industries and you just dump the bottom third, just get them out of your asset allocation, you're generally going to do at least 50% better than the stock market. Stock market makes 8, you'll average 12 just by asset allocation using ETFs. And you can do even better than that if you overweight the really good sectors and industries. So as we've talked about in this new innovation world, sustainable growth world, adapting to the slow growth generality, where you have to avoid the slow growing and the no growing industries. If we stick with the growth industries and try to find those little pockets of value that pop up once in a while, and then ride the value and the momentum in the growth areas, we can do really well. So one of the things that we've been doing is, what do we do about oil? Oil was our one stinker trade, and we're going to go in that direction now. We saw today a headline. Actually, I think I have the Bloomberg version of this. Again, Bloomberg just so good. Search for oil. Look how they lay that out for you. Saudi Arabia is really cutting back on exports again. And they're basically saying, look, we're going to tighten this market up. And I think that the Saudi Arabians may know something. And here's why I say that. China has been stockpiling oil from Iran. And it doesn't show up as trade because they import the oil and then they don't pay for it and they put it in a segregated storage facility. And however the rules of international trade work, it doesn't show up as actual imported oil. The oil got there, it's sitting there, it's waiting for them to use it. But it doesn't technically rise to the level of an import. Why? I don't know. Somebody didn't sign something, somebody didn't transfer money somewhere, it's an IOU and a wink. I don't know exactly how they get around calling it an oil import, but they do. So what we found out in the last week is that with the escalation of the trade war, China is really basically telling us we're not going to import anything from you. They're not buying our soybeans. They're not buying our oil. They're not buying our natural gas. They're basically saying, look, we'll find it from around the world. So over the summer, and this goes back to something I said start of the year, I think February and April is when I really hit on it, is that China would stretch out the trade negotiations so they really didn't have to cut a deal with China, with President Trump. And they're really trying to get him out of office. Why are they trying to get him out of office? Because he's trying to change their system. And the way to have changed their system would have been through a united front with our allies, maybe putting something like a trans-Pacific trade partnership or something, and doing it that way, and forcing China to have to deal with everybody versus just us. So now we don't have the leverage to effect more meaningful change in China because we're on our own, rather than having the Europeans and 3/4 of the Asian nations supporting a unified pushback on China. So what's likely to go on here in the next few months? Well, I think one of the unintended consequences of this trade war is that there might be something going down in the Middle East imminently. The things that I started talking about 2 years ago, I think are very close to happening. China recently went to Venezuela. These guys are on their Belt and Road system, and China is going to fix up the Venezuelan refineries, even though we're putting sanctions on Venezuela. So at this point, China's dealing with Iran and Venezuela on oil, as well as buying agricultural products around the world, in particular from Brazil. How do we deal with all of this? If we really want to cut a trade deal with China, wouldn't we just take the best deal that we could get them to buy a lot of things from us, and realize that we're really not going to change how they do things from a governmental standpoint? Here's where it gets even more interesting. China may set its navy on course for the Persian Gulf. I talked about this over a year ago, that we should probably expect China to get involved in the Middle East. What you're hearing in Dubai, Oman, I'm lucky enough to have a contact in Dubai, and in the Middle East, is that they know the United States is probably going to pull out of the Middle East in the next several years. Why? Because with the advances of electric vehicles, hybrids, and with us having the shale drilling at least flat production to slightly up production for the next several years, we have pretty much extricated ourselves from really needing much Middle Eastern oil. We only bring in about 1.5 million barrels per day, I believe is what it is. So, article that I've been teasing for a week or two now is that, hey, if we just build that last pipeline to Canada, we're done with OPEC. Will that Keystone XL get built? I don't know. Someday maybe. But either way, several years from now, because we'll be just using less oil, we're not going to need to be in the Middle East. Sometime in the 2020s, the United States will really be done with all the oil protection, all the oil wars. We're not going to care about the Middle Eastern oil. And the Saudi Arabians, for them to drop their oil exports down to 7 million barrels a day, right? They were at like 11.5 a while back. That's them basically saying, you know, the United States is just about done with us. We got to figure out something else. So China's going to the Persian Gulf. U.S. Naval Fleet update. See over here, we got 3 groups. I just want to see the, this is over at, there you go, Stratfor. And I keep an eye on this. Here's a scenario that I think is probably very plausible. Will it play out or not? We don't want to be there if the Chinese fleets get there, right? We already bumped into one of their ships. The Russians made a run at us. Doesn't mean we need to go and hide, but at some point, we need to assess what we want to spend in money and blood. And Iran's not going to cut a deal with us either. China doesn't want to cut a deal with us. Russia doesn't want to cut a deal with us. That really leaves only one option to attain your goals. There's probably going to be a military strike on Iran soon. So all these things that have been ramping up since I started talking about them 2 years ago have finally gotten here. The trade war is pushing on this as well. So if the deals can't be cut and we want to put pressure on China, how do you put pressure on China? You cut off their supply lines. So Brazil, we can buy off. Venezuela, we're sanctioning. Iran, we're sanctioning, but the oil is still getting to China. All it would take is a couple of days of cruise missiles and targeted attacks to wipe out half of the Iranian military, in particular the Navy, blow up their nuclear facilities, which will come with killing a lot of their top scientists, and we could blow up some of the oil infrastructure that's exporting oil in Iran. I believe that that's probably going to happen this fall. Everything points in that direction. The economics, the geopolitical struggles, the fact that it would be a proxy war, not a direct war with China or Russia. Should these things be happening? No. We royally screwed up when we got rid of the Trans-Pacific Trade Partnership. And I know that a lot of people are like, well, you know, it was bad for labor and bad for this and this thing and that thing. You know what? You can work on details. But people looking for perfect deals, man, when have you ever had a perfect deal? What's the biggest deal you make in your lifetime? It's marriage. How many people have a perfect marriage? Nah, there's little things. And you work on them. If you're going to stay together, you work on them. You know, to the handful of you that have a perfect marriage, get a TV show because you're one of the only ones. But what's going on right now between China and the United States is so remarkably dangerous that not only could it push us into a recession next year, and I'm fairly certain that it will, because China wants Trump gone. And if there's a recession next year, Trump can run on fighting with China all he wants. But if people are losing their jobs, they're not going to vote for him. So China is doing what it can to put pressure on us and put pressure on us, particularly next year. Now, China can't do without us forever. But, as I said a long time ago, they can stretch things out on these negotiations. They can put economic pressure on us for a short term, and they can stockpile what they need. And that's what they did. They stockpiled a ton of food and energy in the last several months. So I think the response is going to be to attack Iran, to at least take away some of their oil and gas. And then maybe there's a deal cut. If that attack happens, the price of oil, that bull market that I've been expecting, finally starts. If there is no attack on Iran, then the bull market in oil probably doesn't start until the Democrats get in control. 2021, 2025, whenever. And if the Democrats don't win in 2021, by 2025, oil demand apparently is going to stop going up. We are already seeing from the IEA, oil demand increase will be under 1 million barrels per day this year. So less than 1% increase. Now, that's partially driven by the slowing economics, but the structural changes in the economy are permanent, not cyclical. So, 1% increases seem to be the norm, down from 3, down from 2, down to 1. What's the next number? We are about to enter that peak oil plateau in the next several years, where oil demand flattens for a few years before it finally tails off. And then about 8 to 12 years into oil tailing off, it falls off a cliff with the retirement of the ICE vehicles. So what do we want to do with our oil holdings? Here's a chart that I think you should be really aware of. U.S. Oil Fund was just last year. XOP gotten his ass kicked. But look at this, clean energy and solar are up by quite a bit. Now take a look at the 10-year chart, right? Solar and clean energy fell off that cliff here, had the rebound, fell off another cliff. So long term, you'll hear these people, or you'll see these people on message boards, solar's always gone up and down, and it always goes down, and blah, 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 blah. Technology has changed. These curves don't look terribly different than some of the technology curves from 30 years ago. Let's go to the 5-year chart. All of a sudden, over the last 5 years, since the big oil shock, the oil investments have been down here. And while the solar and clean energy haven't done well, they've done relatively way better. See how this is changing from 10 years, 5 years, 3 years. Now all of a sudden, solar is the one that's taking off, which is the one that I've told you would take off. That's why we're in sun power. That's why we're talking about end phase. We've been in end phase, and I stupidly sold it. First solar for the utilities, sun power for commercial and residential. Sunrun we should probably talk about, but we haven't. Their deal with Costco is could be a big deal going forward. And then the last year. So how do you play rising energy costs? Well, I think the first thing is you get on the side of the big secular trend, which is clean energy. Plays into the climate change theme, plays into the sustainable growth. The growth rates on solar are anywhere from 25 to 35% per year, depending on tax law changes and things like that. So you have the secular headwinds on your side. Does that mean you can't invest in oil? No. In fact, oil stocks are so incredibly cheap right now that only one of two things can happen. I take that back. 3 things. They could all go bust. All right, the oil stocks would just start going bankrupt. I think the odds of that happening are pretty slim, given that a whole bunch of them are profitable, starting to return cash to shareholders. Pioneer just announced a gigantic shareholder dividend. So, jumped it up from almost nothing to 1.44%. A huge jump. So, and the stock reacted badly. It's down to 125. I've got calls at 140. So we'll see what happens here. But what are the other things? The stocks could go up, right? Or you could see take privates. And Harold Hamm, Google this one. Harold Hamm basically said there's no point of having stock in the public market anymore. What does that foreshadow? Something I talked about in the last few months. A lot of these oil companies are going to start going private. They might do mergers and take them private, but these executives, if they can cut the shareholders out of the picture and collect all the profits for these companies for themselves for the next decade or so, do you think that they're not greedy enough to do that? Better be careful, because I think a lot of these companies are going to go private if they can't get their shares to rally in the next year. So keep an eye on that. In general, we're better off in the clean energy plays, but there's some gambling you can do with these guys. You may win, you may lose. I think if they go private, you win a little bit. If there's an attack in Iran, you probably make a lot of money. Which companies? Focus on the premium pure plays and the merger and takeover targets. Got a whole list here right on Seeking Alpha. You know, Concho, Diamondback, Parsley, Centennial, Pioneer. Conoco actually, when you take a look at their enterprise value to operating income, this company is a takeover target, I think, for Exxon and Chevron and the other majors. We'll see if anybody buys Conoco. It might be too big to digest. Devon Energy, we know, has been talking merger with somebody. And Kana is so ridiculously undervalued, it's sick. Marathon Oil is healthy. All the companies here are healthy financially, have great rock, and would benefit from rising oil prices. At least they pump out a lot of earnings. Does that mean that, you know, which companies can go private? You know, Harold Hamm can probably take Continental private because he's rich enough to do it and has partners. Some of the other companies, man, I can't see a Conoco going private. You know, some of these companies are $20, $30 billion. I just can't see them going private. But some of these $2, $3, $4, $5 billion companies, they could go private for sure, or they can do mergers. And that's really a way for the executives to steal shareholder money. So if you're a shareholder, you do not want to see them taking these companies private at 10% or 15 or 20% premiums to these depressed prices. But it could happen. So let's talk about gold really quick. We've had this big rally in gold. Newmont Mining and Core Mining are the two that we've been in. Never really did buy GDX, but I think on a stock market rally, gold comes back and we can get into these gold positions. There's probably a pretty good gold miner argument to be made. I don't think that the price of gold is going to, you know, 3, 4, 5,000 or anything like that. I think it's about in the range where it's going to be now, 13, 1400 on the low side for per ounce. And, you know, might push 2,000. With monetary stimuluses to come. This guy points out Core Mining and talks about why he's loading up. Well, if you take a look at the chart of Core Mining, oh, we need one more. Let's just take a look at. Let's just take a look at the last year. So we start talking about it in here, right? Sold a bunch of puts, bought a 5-ish, sold puts. My cost basis is like 387 or something with the put premium. And then I bought, you know, we bought just a couple of calls down here. Didn't really pound the table on it, but this is going to act as resistance. So if gold corrects a little bit, you know, gives back maybe half of the gain off the bottom, gets back into the middle fours. Core under 5, I think, is a screaming buy. It is on our list. I made just another small adjustment. You know, they're in the small cap list. We don't have a lot of small cap stocks right now. But that's a heck of a rally off the bottom, right? So the folks who bought under 4 are doing really well. That silver tip mine is a big deal. So go ahead and read this guy's article. He's missing the point on a couple things. If you understand core mining, it's because you understand silver tip. That mine is a big deal. It is what takes that mine from just being some run-of-the-mill, little barely being able to stay in business, you know, that maybe chop around for a long time. They're turning these guys into a company where Silvertip is basically getting no value by the market, and it's going to start throwing off all kinds of profits. All kinds of money is going to drop to the bottom line from Silvertip. So he mentions it. He just doesn't dive into it. Silvertip is the difference maker. I highlighted that at core. So study Silvertip if you want to understand core. So I think there's going to be a pullback. It's overbought. The daily chart for money flow has started to turn down. So it should come all the way down to here. When you take a look at the weekly chart, you see how overbought it really is. But that's a pretty strong inflow of cash, right? So if on the daily it pulls back and then pulls this back to here, maybe give up about half the gain, 61%, 38%, pick your Fibonacci. You want to buy it again on that. So don't expect it to get all the way down here again. I really don't see that. But this right around here, right around the 200-day moving average, I think you can back up the truck on core mining. You know, go ahead and, you know, buy 2, 3, even maybe even 4 or 5% of your portfolio if you're aggressive. Otherwise, stick with Newmont, right? Newmont, number 2 player in the whole industry. You know, we accumulated, you know, last several months, sold a lot of puts. When they did that merger, where would that have been? Right around here, right? So what we did with the merger is we knew that there was going to be a big fat special dividend that was going to knock the share price down. So we were able to buy the stock, sell a covered call, collect the dividend, sell a cash secured put. We have a position. We've collected all kinds of premium. And now the stock is up for us. Can this one break out? It's got a long way to go to the upside. Now, if it pulls back into the low to middle 30s again, and you don't have a position, go ahead and start buying it once it gets to around 35, 34, 33. You know, that's where you start establishing positions. Again, it's these gold stocks are done. This is the bottom. Consolidation in the industry, demand, monetary stimulus, even deflationary pressures create reasons for people to own gold. So buy the dips on the gold stocks is the point. GDX for you ETF investors, we missed our opportunity. It was right there. We missed it. So it'll come maybe halfway back to us. 25, 24, maybe we get 23, 22, but I don't think so. So middle 20s, add GDX to your portfolios. Now, I told you I'd talk about Bitcoin a little bit. You know that I am a cryptocurrency bear. I believe that almost all cryptocurrencies are going to zero. But Bitcoin is going to be a survivor. Why? Because it's the one that's been adopted the most. You can see that Square, even Square, which is on our sustainable growth list, is getting into Bitcoin. PayPal is putting itself in a position to be able to trade Bitcoin. So there are a lot of institutional reasons that could create Bitcoin getting adopted. Here's the problem. Bitcoin needs to have a much larger supply in order to be used for transactions, right? So money has to not only be a store of value, but it has to be a unit of exchange, right? We have to be able to exchange it. And there are inherent problems with Bitcoin because it basically limits how much it can get used as a unit of exchange. So there is something that's going to happen with Bitcoin. I think it's next year, might be the year after, where it'll basically break up in smaller pieces, and that could help it. But I think what really has to happen with Bitcoin, there has to be some sort of a technological change to it that ties it to another currency. And this is where Libra could be a very big deal with Facebook and some of the partners that they have there. I don't wish a lot of good things for Mark Zuckerberg because I think he's kind of a creep. But I think he's got the right idea with Libra. And the big fight with all these cryptocurrencies, other than most of them don't make any sense, is that you have to deal with the regulators. So between Libra and Bitcoin, those are the two places I want to look. So I played around with Bitcoin. I bought Bitcoin at a little bit under $2,000 this year. I just put 10 grand into it. And I just sold it last week on that pop. So I don't know, 11 something I got, I think. I bought it on Coinbase. Had I known that Robinhood was doing it, I probably would have used Robinhood, but I bought it on Coinbase. And then you don't really want to keep your cryptocurrency that you're just holding on to at the exchange because that's where the hackers go. So I moved my Bitcoin off of Coinbase over to blockchain.info is the website, blockchain. It's just a wallet. And then when I sold it, I moved it back to Coinbase. A couple little fees and whatnot. But, made almost 6 times my money, I guess, in under a year. Now, here's what I think about Bitcoin. There was an article written by, I don't know if it's on her website or not. If we go to Beth Kendig, is somebody that we follow. And she's really smart. She loves Bitcoin. And I think she made a mistake. But I would read her articles if I were you. Just understand what she's saying. I think she makes some economic mistakes in her assessment of cryptocurrency. And I think that a lot of people do. These Austrian economist types, I'm telling you over and over again, they make some psychological mistakes with regard to the economy. And they don't really understand because in their head, they're equating micro and macro and it's not the same. So the problem with Bitcoin, again, is it doesn't really fulfill all the real functions of money. And the imaginary monetary system that the Austrian economists dream of doesn't really work. So in order to grow the economy, you need expanding monetary bases. And that is a problem for Bitcoin that they have to fix. Libra could fix that. I don't know if it can be fixed with Bitcoin. So with Bitcoin, Beth made a point of saying that the support levels for the price of Bitcoin would rise. If you take a look, let me find the chart. I think that's the opposite of what's true. the support levels for Bitcoin are more likely to fall. So let's take a look at this chart. Okay, adoption. This is the mania. This is the Chinese taking their money out of China and getting Westerners to pay them higher and higher prices. Because the Chinese were 80 to 90% of the Bitcoin mining in here. Chinese wanted to get their money out of China. Price starts going up. Mania. Chinese are dumping their Bitcoin. Bitcoin crashes, falls off the cliff. Institutions start to buy Bitcoin. Create a mini mania. Look at that. Look at this area. Look at this. It's just a smaller version. The support levels for Bitcoin are going to go way down. So the next time it crashes, which will happen in the next couple of years, it's going to go under this level. I think it got down, it was a little under 2,000, right? Under 4,000. I must have bought a little under 4,000, whatever. I bought it right in here. So I don't pay that close of attention to it. I just want to understand how Coinbase works and those things and the wallets. Don't tie your wallet to your computer or your cell phone in case the computer or cell phone breaks, right? So you have to use something else. The next support level for Bitcoin, and I've been listening to some other people, apparently is that's what's under 2,000. The next support level for Bitcoin is like 16, 17, 1,800. So that next drop probably gonna come way down here. Just see, right? Look what's happening. This is a mania. The air's coming out. And you can take a look at charts like this going back to any mania. You always get the reflation, the hopesters, the hucksters, then it comes back. But Bitcoin, there's enough Bitcoin out there, enough people in it, that if they fix that monetary problem that they have, right? You don't want stable currency. You want slowly expanding currency. And that's the problem they have to fix here. Right now, all this really amounts to is a barter system. Barter economies don't grow. So we'll see. The millennials don't understand any of that. So they just bid it up and down, and they trade it, and they think they're real smart. But I know guys, a guy at a Christmas party told me that he bought it in here, and at the Christmas party, I told him to sell it because he had been up 20 or 30 or 40%. I don't know why he didn't sell it, but I just saw him at a baseball game. He said, yeah, he sold it recently. So whatever, he lost money. Most millennials are going to get crushed on this stuff because they don't understand why it exists. They just grab onto the narratives of, oh, fiat currency, fiat currency, fiat currency. So be careful with this stuff. You don't want to buy it in here. But the next time it crashes, if it looks like they're fixing the unit of exchange problem, then you may want to accumulate some. So between Robinhood and Coinbase, at some point, then you find a digital wallet. Blockchain.info is the one I used. And I guess there's a couple others. You can do that. So don't get all pumped up over this. If you want a currency hedge, something that has more value, some real value, you want the gold miners. Again, price of gold is going to be range bound, 1,300-ish to 2,000-ish. You can certainly trade it. But the gold miners are just going to have money falling to the bottom line because of all the consolidation in the industry. and all the fixing of their balance sheets. So that's where I'd go with that. If you want to speculate on an on a strike in Iran, I think USO is probably a speculative trade that you can make, right? Could see we could see the price of oil spike to 100 for sure, 120 maybe. The idea that oil is going to go up much higher than that, no, it won't, because at that point then Saudi Arabia opens the spigots, right? So there's some trades still available in oil, but you got to be nimble. You have to understand what you're doing, and I think it's still the Permian merger and acquisition targets that are where the most leverage is, especially since they're just beat the snot out of them. Again, take a look at these stocks. I mean, at the low end of the range, Pioneer is right now. And you just go through all these stocks on 5-year charts, right? They're all beat up. One other thing, people have been asking me about natural gas stocks. There's a trend that you need to be aware of. Coal power plants closing are not going to natural gas. Maybe a third of them, but probably less. Alternative energy has been getting those deals 2/3 of the time. It's happening in Indiana, and they have the highest use of coal as a percentage of energy in the country. And they're switching to solar and wind and batteries. So I would keep an eye on the battery technology. That zinc air that I told you about a year ago made the press again recently. So some sort of combination of zinc-based air batteries versus liquid, and lithium air batteries versus liquid, right? Those are the future. And we don't know which companies are going to win there yet, but I think Tesla is one of them. That is why he basically started to end his relationship with Panasonic. He's got something else coming. When does he announce it? I've said I think they announce it before the end of the year. And given that sales there are choppy, he might need to make an announcement. So we'll see. Also with Tesla, this is just your weekly Tesla update. Some sort of deal with GM looks more and more likely. GM needs to get electric vehicles out there in the next few years, and what they have is just not very good technology. LiDAR, everybody's starting to figure out that LiDAR is not going to be the way to go. You want AIs in your cars that have no latency communication with the edge computing, and Tesla is a leader there, and Google is a leader there. So that's the future. You know, if Google's telling you that's the future, it's probably the future. So by Google on pullbacks, by Tesla on pullbacks, we have our support levels on the charts. You know, and those are your big growth companies. If you haven't been divesting your slow growth companies, your no growth companies, companies that you think are value, they're not. A value stock is not a value stock unless there's underlying growth. Get that through your head. A value stock is not a value stock if there's no underlying growth. It's a value trap. So take a look at the revenue growth numbers. I showed a whole bunch of them recently. If there's no revenue growth on the top line, and they're somehow making it through financial engineering and low interest rates, sell while the selling is good. And it's a third of the S&P 500. So when this next recession finally does hit, that 1/3 of the market, that's going to be your tech wreck from 20 years ago. Those are going to be the companies that lose 50, 60, 70, 80, 90%, and some go bankrupt. All right. So let's take a look at a couple of questions, and we'll call it a day. By the way, went to the state fair yesterday. Didn't stay long, but I got to visit the pigs, and the pigs are magnificent. Somebody says if your Iran scenario happens, I guess we have another country to rebuild. So buy Halliburton? No. Halliburton's done. And we wouldn't be the ones to rebuild Iran anyway. Do I think the U.S. is involved in Hong Kong? Sure. Yep, I kick myself for selling Enphase for a double as well. That could have been a six-bagger. The shareholders get a token payment if the oil companies go private. So when any company goes private, there's a price that the management agrees to pay, or whoever, the private equity firm and the management agree to pay. I'm telling you, private equity firms are hovering over the oil stocks right now because these companies are going to be profitable for a decade. And if you cut out the shareholders, you get to swallow those profits. And with the way the institutions are divesting, I think they would just take what they can get. So I think traders, option traders, are really the only people that should be in the oil stocks right now. Right? I mean, we might get a rally on an Iran attack. I guess you wait to see if that's going to happen. But otherwise, you got to figure out what, I certainly wouldn't be adding too many of them. But, the companies on that Permian list, there's a shot for those. And if they rise, they could rise, they could triple. But again, if you're not an option trader, I wouldn't be doing that. Newmont's earnings were just fine. They're just digesting right now. That was a huge merger. They're just digesting right now. Oh, somebody says they knew people who bought Bitcoin near the peak and they're waiting to get out even. It's not going to happen. They should be selling right now. They're never getting all their money back. Micron, love Micron. Have they pulled back enough for us to buy yet? I want to see them in the 30s. Right about there. What's that? Yeah, 30 mid 30s on Micron. I think that's what we're looking at. What's the VSL number? Yeah, 34. I think I'd buy Micron a little bit at 34. And if it went all the way down here again, then you should probably buy leaps or not. Here's my thinking on leaps versus short-term calls. I don't like paying for all that time value on the leap. I've just even if I buy a leap, I'm probably trading it sooner. So again, if you're in options, use that leverage to get moves, and when you get your move, you take your profit. Make your double, make your triple, whatever it is. So I don't think you buy a leap with the idea that you're going to hold it for 2 years. If you buy a leap, you're doing it to get a little insurance in case your catalyst that's in the short term doesn't manifest. So I've been rolling my calls more often than buying leaps lately. The math works out better in most cases. Not all. Yeah, oil between 50 and 70. If there's no conflict in the Middle East, probably closer to 70. Because all the trade war stuff is pretty much priced in. Antero is still a fine company, but just because of their proximity to the East Coast and their oil sands, their natural gas holdings in the Marcellus are real good. Somebody was talking about their relationship with Antero Midstream. Antero should be pumping as much as they can. That's not a problem for them. They just need higher natural gas prices. And again, I think that's one that is part of the whole speculation. But with oil, with conflict, and with a deal with China, if I own the stock, so I'm going to hold that stock to the 2020s because I think that, again, oil and gas prices go up under Democrats. I think the Democrats are like 90% likely to win next year. So there's that. But again, the focus of your portfolio should be on the sustainable growth stuff, the stuff that has underlying growth. We're in an exit strategy with all of the fossil fuels. It's just a matter of how fast we get out. We're looking for a rally to sell into. We don't want to be the idiot emotional fools who sell because, oh my God, it's down, and I hate when it's down, and I feel bad. No. You wait for a rally, you get out and say, okay, that one didn't work out so well, and move on to the next one. Arctic drilling. No. Arctic drilling will never be cost effective, and it's never going to happen. CenturyLink has started to solidify. I like CenturyLink still. AT&T's, I prefer AT&T at this point, but CenturyLink has got valuable, irreplaceable assets that somebody's going to buy. Hey, Dividend Sleuth sent me a private message. I'm going to tell you what it said. He said he recovered from his 50th high school reunion and he's ready to write something again. What's the next project? All right, let's figure it out. Okay, so this weekend I'm going to put out a quick article. Here's your highlight for Invesco. I think you go ahead and start buying Invesco shares if you're a dividend growth investor or a retiree looking for something low volatility that pays out a huge dividend. The dividend on Invesco is over 7% right now. The stock is digesting, the company is digesting Oppenheimer, and they're moving people from mutual funds to ETFs. It's a multi-year process. But the demand for ETFs just keeps going up. Invesco and BlackRock are the leaders. iShares and Invesco. iShares is starting to move into Europe. Invesco is right behind them, right? It's because Europe passed a regulation. Now they got to jump through some hoops. So at some point, Invesco has fully digested Oppenheimer, and they're gonna be one of the best dividend payers out there. Will there be a ton of growth? No, it won't be a ton of growth because the gigantic growth in ETFs already happened, right? But there'll be continued growth. Over time, the mutual fund industry will mostly disappear. And you'll get more of the managed ETFs, like the ones from ARK Investments that we're in. And that's going to be the way the world is. So mutual funds will become ETFs so they can trade daily, intraday. Invesco, BlackRock are two leaders there. BlackRock, you buy lower yet. It needs to go lower. But Invesco, you're getting the bargain price because of the indigestion from the merger. And merger indigestion is usually a great time to buy, just like with Newmont. So I'm telling you, now that it's under our bottom fishing price a little bit, go ahead and start buying Invesco. Probably buy a little bit this afternoon. Don't go crazy. 1%, 2%, 3%, right? That's your normal position. But it's a real nice dividend. So I think Invesco over the next 5 to 7 years probably doubles, and you're collecting a 7% dividend to boot. So you might, make 2.5 times your money over the next 5 to 7 years as a conservative investor. That's not so bad. You can actually have this one in a growth portfolio too, because then you get those dividends to use to buy more aggressive stuff. So in my growth portfolios, I have dividend stocks, and I just use that cash as it comes in along with the option premium to buy more growth stocks. 20, 30% of the portfolio in dividend stocks, even in a growth portfolio. Yeah. Carl Icahn's got everything wrong on energy for the last 5 years. he's not the guy to listen to. The Occidental-Anadarko merger is a very good merger. Here's why. Because she knows, that the CEO of Occidental knows to sell assets, right? They developed and then they sold that export facility in Texas. How smart does that look now? By combining the Permian assets of Occidental and Anadarko, you have a company that could sell everything else they have. Everything. They sell everything else, be a debt-free company, pumping out gas and oil from the Permian for the next 20, 30 years. Oh, and by the way, they're the CO2 leader. That's where the future is, the CO2 business. They can sell everything else. I think they're going to. Icon just has it wrong. He's got a lot wrong lately. So the last 5 years have not been kind for Carl Icahn. He sold Netflix way too early. So, I'm not saying he's lost it. I'm just saying he's wrong. Yeah, natural gas liquids are beating the hell out of a lot of the gas companies. But, again, IMO 2020, all these shipping companies starting to switch to lower sulfur fuel. The gas oil is becoming a bigger and bigger deal. So the world is moving towards lighter, sweeter crude. The problem is the refining, right? So it's a slow process. And then we're just going to be off oil in 30 years. So the forces are against oil in general in the long term. But there's probably this rally phase, this profitable phase that happens first. So we want to be with the companies that are selling off assets and looking to the future. Exxon and Chevron, they're just too damn big. They're going to do split-offs eventually. And what I'm probably going to want to buy is when Exxon and Chevron break up, and they're going to break up, you're going to want to buy their real estate holdings and whatever they spin off that looks like it could turn into alternative energy, right? But they own all sorts of, real estate. So that'll crash a lot of real estate markets, and you pick it up when it's burning. So I just said 1, 2, or 3% on Invesco. 1, 2, 3% is a normal position. 4, 5, 6% are double positions. That's too much in most cases. 1, 2, 3% on a stock for position in your portfolio. I think you can pretty much go straight to 3% though on Invesco because it's so cheap right now. All right, have a great weekend, everybody.